Start with the US dollar. The USD, as the world's leading reserve currency, often reacts strongly to unemployment data. When unemployment rates rise, it typically indicates a slowing economy. In response, the Federal Reserve may choose to lower interest rates to stimulate growth. Lower interest rates can make the US dollar less attractive to investors, leading to a decrease in its value. Now let's pivot to US indices. These are essentially barometers for the US economy, comprising a basket of leading companies. When unemployment figures increase, it's often a sign of economic contraction. Investors may anticipate lower corporate earnings, leading to a potential sell-off in the stock market. This can result in a decline in the value of US indices such as the Dow Jones Industrial Average or the S&P 500. But what about gold? Traditionally viewed as a safe haven during times of economic uncertainty, gold prices often rise when unemployment figures increase. Why? Because investors may seek security in the precious metal, driving up demand and thus its price. Next, consider crude oil. The correlation between unemployment rates and oil prices is often indirect. High unemployment could signal a slowing economy, which in turn could mean less demand for oil as businesses and consumers cut back. This could lead to a decrease in oil prices. Lastly, other commodities. The impact of unemployment rates on commodities like copper, soybeans, or wheat can vary. However, generally, a rise in unemployment can suggest a slowing economy and reduced consumer spending. This could lead to decreased demand for certain commodities, prompting a potential drop in prices. To summarize, U.S. unemployment reports can greatly influence various markets. An increase in unemployment rates can lead to a decrease in the value of the USD and U.S. indices, while potentially bolstering the price of gold. Crude oil and other commodities prices may also fall due to anticipated reductions in demand. So always keep an eye on those unemployment figures. They're not just numbers on a page, but key indicators of economic health that can signal important shifts in various markets. The more you understand these dynamics, the better equipped you'll be to navigate the financial landscape.